Okay, thank you for joining us to this IAA and IASB webinar on the actuarial support for the implementation of IFRS 17. Please note that this webinar is being recorded. The recording and slides will be available on the IAA website later today. Please use the Q&A box to submit your questions to our panelists. I will now turn over to Gábor Hanák, IAA President, for his introductory remarks. Gábor?
Good morning, good afternoon, and good evening to everybody who participates in this webinar of the IAA on IFRS 17. The presenters today will be myself and Darrel Scott, a member of the IASB, the two co-chairs from the Education and Practice Subcommittee of the IAA's Insurance Accounting Committee, Wright and the Finnis, and then the ISAP 4 Task Force Chair, Micheline, Dionne. We have a live audience in the London office of Micheline. And thank you, Micheline, for hosting this event in London. Also, we have an audience in Cape Town where the IAA sections run colloquia, and there are a couple of, quite a number of people, like 40 people in this room listening to the webinar. Next slide, please. So this is the agenda for the day. I will say a few introductory words, and then I will ask Darrel, who's a member of the International Accounting Standards Board, to talk about the background and development of IFRS 17 and a kind of a status update. Then Derek and Dave will talk about the International Actuarial Note 100, application of IFRS 17 insurance contracts. And then we will turn to Micheline Dionne, chair of the IFRS 17 task force, or ISAP 4 task force rather, of the IAA's the ASC, the IAA's ASC, the Actuarial Standards Committee, on the standard, the status of the standard, and then we will have a question and answer period. So next slide. So the purpose of the day is to give an update to the global actuarial community on some of the key matters related to the implementation of IFRS 17 from the IASB and from the IAA point of view. The intended audience includes those actuaries and perhaps other professionals who have an interest in insurance accounting under IFRS. We received over 500 registrations. I see currently nearly 200 people came to the webinar, and the number of countries is 70 from where we have the registrations. For practitioners using IFRSs, the implementation of IFRS 17 will mean a fundamental change in thinking, approaches, techniques, models, and communication. This is a standard that requires actuaries a significantly higher level of understanding of accounting principles. It also requires accountants a significantly higher level of understanding of actuarial principles. So talking to each other and understanding each other is key when applying and implementing IFRS 17. The IASB and its IFRS 17 Transition Resource Group have been addressing the concerns industry and professional organizations like the IA have raised, and it seems that the end of this process is very close now. You'll hear more about it from Darrel. I would like to note that William Hines, who is the chair of the IAA's Insurance Accounting Committee, is an observer member of the Transitional Group for IFRS 17, and I understand that this Transitional Resource Group will have a meeting just tomorrow. A few words about the two topics which will be the IAA's part of this webinar. What is a standard of practice, standard of actual practice, and an international actual note. So a standard of practice of the IAA is a model of a statement of behavior expected of actuaries operating within the specified context. ISAPs are model standards of actuarial practice and as such are not binding on any actuary. The IA, however, encourages relevant actuarial standard setting bodies to maintain a standard or set of standards that is substantially consistent with an ISAP adopted by the IA to the extent that the content of that ISAP is appropriate for actuaries in their jurisdictions. On the other hand, an international actuarial note, an IAN, is an educational document that provides information on current or emerging practices in relation to an international actuarial topic, but it does not provide guidance on that topic whatsoever. That's the role of the ISAP, the International Standards of Actuarial Practice, as implemented by a standard setter. So we have out there for consultation IAN International Actuarial Note 100. The deadline for comment is April 26th. And we also have out there for consultation ISAP 4, International Standards of Actuarial Practice 4, insurance contracts. This is the second exposure draft, and the deadline for submitting comments is end of April. So, as Christian mentioned, there will be an opportunity for Q&A after the presentations. Ask everybody who want to ask a question only, send one question only. We will hear questions from the live audience first in the London office of Milliman, and then we will return to your questions asked online. And as Christian already mentioned, recording and slides will be available at the IA website. So having said that, I will pass it over to Darrel to start his part of the presentation. Darrel.
Thank you very much, Gábor. Good afternoon, everybody from London, and good morning, good afternoon, and good evening, wherever you happen to be. That's quite a nice exotic thing to be able to say at the beginning of a presentation. I'm going to jump directly into my slide pack, so if we can move on, I think, to slide 8. What I'm going to do is just be giving you an overview of where IFRS 17 is right now, with just a little brief reminder as to why we do IFRS 17 talk. Can I perhaps ask others to mute their mics on the? It's coming through quite loud on the webcast. Thank you. Talk a little bit about the background to IFRS 17, why we have it at all. Talk a little bit about the timeline. I'm also going to give you a highlight of how IFRS 17 actually works. Clearly, if we had a whole day and a whole other day, I might be able to go into the details. So this is going to be a very high-level overview. And then I'm going to talk a little bit about the process that we're busy with right now, the amendments process to IFRS 17. So just moving to slide 9, which highlights why we did IFRS 17. It's worth remembering, and we've had some discussions about this very recently, actually, about the background to IFRS insurance accounting before IFRS 17. IFRS insurance accounting before IFRS 17 allowed essentially entities to do or to grandfather existing practices in the jurisdictions they were in. That has two consequences. It meant that when you look at insurance accounting across the world now, it is incredibly diverse. There is no consistent stream that runs through it. But even if you look at insurance accounting within individual entities, if their underlying subsidiaries operate in different jurisdictions, they essentially have a mix and match accounting when they get to a consolidated view. So you'll have inconsistencies like fair value on the balance sheet, historical cost on the balance sheet, current rates, asset rates, historical rates, all mixed up on the same balance sheet, all mixing up through the same income statement. So what IFRS 17 is essentially doing is bringing that all together and having a single approach to IFRS accounting for insurance contracts. We think that's a significant development, but it's a development that is clearly not without a significant amount of hardship as well, because it means not only are we requiring everybody to make significant changes to the way they account for insurance contracts right now, we're also asking them to embark on a journey that is a different journey for every single entity. When we introduced IFRS 9, we asked entities to move from IS 39, which was a common starting point, to IFRS 9, which was a common destination. Everybody embarked on the same journey. In this change, we're actually asking people to move from wherever they may have been across a myriad of different accounting towards one consistent view. And that's made the conversation difficult for us. It's made the conversation difficult for advisors and for auditors, because every time you engage in a conversation with an insurance entity, you're having to talk about a different road that they have to follow, a different type of system development, a different approach that they might make to it. It is a significant standard. One of the things that's interesting is that to our knowledge, there are only about 450 listed insurers who apply IFRS. But that's actually a very small count when you consider it, because there are a number of jurisdictions where IFRS is the only available accounting methodology. And so we know of single jurisdictions that have far more than 450 insurers that will be adopting the standard. The effective date, as it stands, as it's written right now in IFRS 17, is 2021, but I will talk in a moment about some of the changes, recommendation or proposed changes that we're making. And that gives each entity, or that gives entities from the date when we issued IFRS 17, 3.5 years to adopt the standard, which in the context of IFRS standards is actually quite a long period. Our typical standard time period is 18 months. We've extended that with some of our more recent standards up to 2 years or 2.5 years, but 3.5 years takes into account the significance of the change that we're expecting. While I'm on this slide, I wanted to make one other point which I think is important, and why we welcome working together with the Actuarial Association, and why we welcome the exposure draft that you've put out at the moment. IFRS across the board is a principle-based approach to standard setting, and we do that very deliberately because we want the standards to be adopted in different jurisdictions for different products across different environments within the world. And so we set our standards at a principle level. That means when people come to apply standards, they have to make a lot of judgments. They have to go through an in-depth thought process about how those principles relate to the transactions that they're dealing with. And so the type of initiatives that the Actuaries and the International Actuarial Association is undertaking is welcome, because what that does is it provides an additional framework, an additional template that entities and actuaries themselves can use as they apply those judgments. A thought process that you can actually go through as you get into the process. Okay, so moving ahead to the next slide and just talking a little bit about the timeline. IFRS 17 was issued in 2017. The ISB undertook during the course of the process during which this implementation occurred to provide support to preparers as they work through the process of doing it. But you can see the arrow across the bottom there sort of fades out over time. And that's because we acknowledge that support in the early days is really useful. Support in the early days helps people as they start to think about judgments, as they start to think about the process. But the further into this process you get, the more disruptive support from us becomes. So when we come out with a pronouncement in 6 months' time or a year's time, or we come out with an interpretation, and entities have already gone down a particular path in their implementation processes, that can be disruptive. And so what we try to do as we evolve through this process is to become less and less involved and to step back a little bit. If you can just press the button again on your side. And again, I think we had originally intended that we would start the process, that we would go live, if you like, in 2021. But subsequently, what the board has proposed to do is to move out the start date of IFRS 17 to 2022, 1 January 2022. That was a decision taken because we had entered this amendment process, and we felt that some of the consequences of the amendments might be that for people in the implementation process, there may be things that they have to revisit because of an amendment. We felt it was necessary to give people time to consider the amendment process. We considered whether we should extend it further, whether we should move it out beyond 2022. But our view at the moment was that we think people can achieve it by 2022. And what we're hearing from regulators, particularly non-Solvency II regulators, and what we're hearing in particular from investors, is that this is something they really need to improve the accounting for insurance companies. And the longer it takes, the longer the period in which they're losing out information. We've also heard from a number of the big preparers that every time you extend the period, essentially what happens is you tend to find that your project timeline extends to fill the time available to it. And so the project actually becomes more expensive because you're not going to lay off the 150 people for a year and then re-employ them in a year's time. You're not going to stop the systems development for a year, so you just keep them on the payroll for a year longer than you might otherwise have. So there's a lot of call from a preparer perspective for certainty around this process. That timeline means that 2021 will be most likely the first comparative period that people will use, and that you will start to see the first set of financial statements being generated in 2023 under the IFRS 17 framework. So moving on to slide 11. Sorry, that's just the when we expect to. Moving on to slide 11. I'm going to start now, if I can press one button, by talking about cash flows and discount rates. And the background to this slide is this is just a high-level overview of the IFRS 17 model. The IFRS 17 model is at its core a discounted future present value model. So we start by looking at cash flows, and we say that you need to prepare an unbiased estimate of your future cash flows. Unbiased is a really important word here. You do not risk adjust those cash flows. You use an unbiased average of your expected future cash flows that you think are going to be coming in on a particular contract. And you use a discount rate that is relevant to those cash flows. Now that might mean that the discount rate is a discount rate which is risk-free, if that is the nature of the cash flows. Or if the cash flows reflect underlying equity markets, for example, it might be a discount rate that reflects those the risk inherent in the equity markets. Taking the cash flows and discount rates, what you get is the present value of your future cash flows. That's the first of what we've termed the building blocks in the IFRS 17 model. So you can press the button again on your side. So the present value of future cash flows, and again, this is a generally understood principle. The third level, moving on to risk adjustment, is a specific and explicit risk adjustment. So you remember I spoke about the unbiased cash flows. You discount them with a discount rate that reflects only the financial market characteristics of those underlying cash flows. Now you have an explicit risk adjustment for those cash flows that captures the risk inherent or the uncertainties inherent in those cash flows. This is an entity-specific measure. So when I think about fulfillment cash flows, or when I think about the present value of future cash flows, that should arguably be exactly the same for all entities that have the same expectations about the future. When I talk risk adjustment, that may be different from entity to entity. So an entity, for example, that has a very diverse basis is likely to have very diverse risk. So multinational insurance with multi-line insurance products is likely to benefit from diversity and therefore have a lower risk adjustment than a monoline single jurisdiction insurer who may be exposed to risk only in that one jurisdiction. Clearly that's absent the assumption of reinsurance. Reinsurance is one of those things that may lead you to reduce your risk adjustment. The way we've defined risk adjustment in IFRS 17 is to say the risk adjustment is the compensation the entity demands. So an entity-specific measurement looking at the way the entity looks inward at its own risk adjustment. Taking the present value of future cash flows and the risk adjustment and putting those together, we get to this concept of fulfillment cash flows. Fulfillment cash flows now essentially captures your future expectations of what you expect to receive over the life of a contract at inception, and is updated at each reporting period for your changes in expectations, as well as for cash flows that have already happened. So it's a forward-looking measure, so you're updating it as you receive those cash flows over time. Now, in the context of where we're getting to, this measure, fulfillment cash flows, is very similar in concept to the principle of best estimate liability. It captures the actuarial principle of those future cash flows that I'm thinking about. Because IFRS 17 is more principle-based than other measures might be in the space, what you would tend to see under IFRS 17 is that you have some You've got the objective to think about what interest rate you use, how you think about your cash flows, and as we've talked, what the risk measurement basis is. But essentially, it comes very close, as I say, to the best estimate liability that is typically required by a regulator. And that top line of this graph, as I say, is the actuarial principle. If I now move forward to the next element, the contractual service margin, the contractual service margin is very much an accounting principle. What that does is it says that when I determine my fulfillment cash flows on day one of a transaction, hopefully that I'm expecting that the present value of my future cash flows at inception of the contract, adjusted for time value of money and adjusted for risk, lead me to an expectation that I will receive more cash than I will pay out. In other words, I expect the contract to be profitable. A regulatory regime typically treats that surplus, if you like, on day one as capital and goes directly to capital. And that's because regulatory regimes don't consider performance measurement over time. Accounting methodologies do. So we take that unrealized profit, that profit that you've calculated on day one, and we say, well, you don't recognize it immediately because you have not yet performed under your responsibilities to the contract. You have a responsibility to the policyholder to provide this standby service right up until the point that you receive a claim or until the contract matures. You can only recognize that unrealized profit as you satisfy that performance obligation to the policyholder. And so the contractual service margin is calculated on day one and then released over the life of the transaction. And moving to the final point, if I then take the net of my fulfillment cash flows and my unrecognized profit, I would recognize an asset or a liability at inception of an insurance over the life of an insurance contract. At inception, by definition, that asset or liability should be zero, because I'm saying that I expect to receive net income over the life, so that's an asset. But I expect that represents my unearned profit, which is my contractual service margin, which on day one is a liability. And then as cash flows happen, as I release profits, so that equation changes. But the combination of these two elements together is the asset or liability that an insurance company presents on their balance sheet. So at a high level, that is the IFRS 17 model. I then wanted to move on to talk a little bit about the proposed amendments to IFRS 17. So moving on to slide 13. And just very high level here, what I wanted to first do is just mention why we're doing amendments. Over the course of the first 14 months after IFRS 17 was released, the ISB spent a considerable amount of time engaging with preparers, investors, regulators, and others. And during the course of that discussion, we identified what we call the 25 challenges that had been brought to our attention. Essentially, these 25 topics constituted topics that people found were giving rise to either operational costs or implementation costs as they implemented them, or were giving rise to unexpected outcomes. As the ISB said, what we'd like to do is we'd like to discuss these topics to understand how and whether we can ease the implementation effort that was going on by entities. But we set ourselves a target of easing that implementation process without reducing the useful information that IFRS 17 was providing to investors. And through the process of that, we identified the 8 topics on the slide here. These 8 topics could be further divided into 12 subtopics, and they represent specific areas where we believe we can ease implementation without reducing useful information to investors and regulators. I'm going to touch on these topics very quickly. I'm not going to go into any detail, but you have the information to take away in the slide deck. So moving to slide 14, I'll talk about the first one, and this is the one that I actually alluded to a moment ago. The ISB has agreed to extend or to defer the effective date by 1 year of IFRS 17. So it moves from date of application of 1 January 21 to date of application 1 January 22. We've also agreed to move the date of IFRS 9 for those insurance companies that are able to delay implementation of IFRS 9 so that IFRS 9 and IFRS 17 can be implemented at the same time. Okay, moving on to the next slide, slide 15. During the process of implementing IFRS 17, we've heard from a number of banks that some bank products, particularly loans with a debt waiver, fall under IFRS 17. We don't think that's wrong, because we think a debt waiver is essentially a form of insurance contract, so clearly you're getting a benefit from it. But we also think that IFRS 9 provides appropriate accounting for these products. So IFRS 9 is able to deal with that debt waiver clause in the way IFRS 9 is set up. And so we've agreed to allow entities to pick between IFRS 9 or IFRS 17. And I should mention at this point, bottom right-hand corner of this slide, all of these things that I'm talking about now are proposals. They will go to an exposure draft that will be published in the next 2 or 3 months. On the basis of that, the feedback on that proposal, we'll either finalize or not these particular proposals. Slide 16 deals with a very related issue, which is credit cards that have embedded insurance products in them. And that relates both to jurisdictions where there is a regulatory requirement that a credit card provides some consumer protection to the credit card user. For exactly the same reason as the previous one, we have agreed that this should be accounted for under IFRS 9 rather than IFRS 17. Slide 17 dealt with acquisition cash flows, and this is the specific circumstance in which an entity incurs acquisition cash flows at inception of a contract that relates both to the existing contract and to future renewals of the existing contract. And what we said in this circumstance is what an entity, or what we're proposing in this circumstance, is that an entity is allowed to take that acquisition cost and allocate it to both the current generation of contracts and any future contracts to which it relates. So the simplest example here is a lot of short-term, for example, motor contracts. There is a commission payable at inception of the contract. That commission anticipates that the contract will be renewed on a 50% probability and perhaps a 25% probability in the next 2 years. So the determination of the commission is based on the expectation of future renewals, and in that case you will actually treat the commission as an acquisition cost for both the first contract and for later contracts that are incepted. Slide 18 deals with how you allocate the profit in an insurance contract, and essentially what this does is clarifies that the profit allocation for an insurance contract is allocated over the longer of the date on which either an insurance service begins or an investment service begins, and continues until the later of which those two services begin. The background to this one is that a number of insurance contracts offer both an investment-related service and an insurance service. And previously, the way IFRS 17 was written is that you recognized the profit over only the insurance period. This clarifies that, in fact, it's recognized over both the insurance and the investment period. And so it's essentially the longer of those two. Slide 19 talks to the risk mitigation option. This specifically relates to those circumstances in which you have a variable fee type contract, so an investment contract, in which you have chosen to use a reinsurance contract to protect you against the financial risks that exist in the contract. Now, what IFRS 17 previously said is that if you have a insurance contract and you have a variable fee insurance contract, so an investment contract, and you've used derivatives to hedge your financial risk, then you're allowed a certain amount of offset. So you get the same treatment of the insurance contract and the derivative in your income statement. There's call it a mirroring approach to a certain extent. We've expanded this, though, to say that a derivative is not the only instrument an insurance company may use. It may also use reinsurance. And so that ability to get consistent accounting on both sides of the income statement is now expanded to this additional principle. Moving on to slide 20. Slide 20 deals with the circumstances, or this particular proposal deals with the circumstances in which you have entered into a reinsurance treaty, and the reinsurance treaty is already written and already exists, And subsequent to that, you write loss-making underlying business. So you actually write loss-making contracts. Now, those loss-making contracts are protected in part or in whole by the reinsurance contract that you have. It's an odd scenario, but it's clearly it's a scenario that we know exists in practice. The way IFRS 17 was written was that because you recognize the loss immediately in profit or loss when you write an underlying loss-making contract, and IFRS 17 previously did not allow you to recognize the offsetting loss on reinsurance, what would have happened is you would have recognized a loss without the corresponding gain from your reinsurance treaty. This amendment just allows you now to recognize the profit and loss at the same time. Slide 21 deals with balance sheet presentation, and this is a problem that probably relates directly to the actuarial profession, the way actuarial models work in many insurance entities. IFRS 17 says that a future cash flow is a future cash flow is a future cash flow. So essentially what it does is it says that all future cash flows must be bundled together. That includes future cash flows where the entity has expected that it should already have received the money. And the simple example there is if you have premiums receivable. Our understanding from many insurance companies is what they do is they strip those premium receivables out of the actuarial model and load them into a separate system. That separate system is a system that essentially captures cash flows as they come in. The concern that many insurance companies had is that because they had already stripped it out of the actuarial system, it was very hard for them to decide which cash flows were supposed to be added back into the actuarial system to catch this to capture these future cash flows. And because IFRS 17 requires you to consider things at a group level, you would have to do some kind of reallocation of your receivable amounts back to the actuarial system to understand what the group position was, asset or liability. So all we've done here is to move it up one level so that we're actually considering this instead of being considered at a group level, we consider it at a portfolio level. It takes away a lot of this pressure on whether or not you're in an asset or liability position. Okay, moving on to slide 22, business combinations. This is a bit of a technicality in IFRS 17 and in IFRS accounting generally, and this talks about the circumstance in which you have acquired a business which has ongoing insurance operations. From a general IFRS perspective, the clock starts ticking again from the date of acquisition. So what you do is you say, you don't look at the transaction as though you'd originally incepted it. You look at the transaction from the date you entered into that business, which might be later than what the underlying company entered into. And this is just transitional relief around how you think about business combinations going forward. Slide 23 deals with circumstances in which you have risk mitigation, and specifically it's providing relief for circumstances in which you have pre-existing risk mitigation on the date that you move on to IFRS 17. Slide 24 talks a little bit about how you can use the fair value approach and when you can use the fair value approach, which again is deliberately designed to give you relief at transition date. And maybe 2 seconds of background here. Typically under IFRS 17, you should do fully retrospective transition. What fully retrospective transition means is you go back and apply IFRS 17 as though it had been in force on the date you wrote the transaction. But you're not allowed to do that typically under IFRS 17. If doing so, you can, under any IFRS, if doing so, you can apply hindsight. So you can get a different answer because you already know what the outcome is. And typically with choices, that happens. If I already know what the outcome is, I can actually change my choice to reflect the outcome I want. So IFRS 17 has provided a number of transition reliefs specifically to allow people to not have to go all the way back. And the main relief it provides is what we would call prospective measurement. You take fair value at the point that you adopt the standard and only look forward. You don't have to look backwards at all. Okay, so those are the changes we're considering. I want to move then ahead to the next steps on 17, which is slide 26. We expect to have completed all of our discussions probably this month. The April board meeting is bringing a couple of sweep issues and is asking the board for permission to ballot. We expect to publish this exposure draft I spoke about towards the end of June with probably a 90-day comment period. That means we're hoping to finalize the amendments to IFRS 17 in the first half of 2020, which would then provide preparers with about 18 or 20 months to finally finish off the application of the 17 standard. We do have another TRG meeting on the 4th of April, which is tomorrow. That will discuss a couple of additional issues that have been brought to the attention of the TRG for us to consider. We have not planned another TRG meeting. We will monitor the submissions that come through. But what we've seen is that the submissions that have been coming through recently are not dealing with principal issues anymore. They're starting to deal with actual specific application guidance. And the TRG can't give application guidance because the problem is fact sets differ. And you can never pick up the subtlety of those fact sets at a TRG level. So although we don't know for sure, there's not likely to be another TRG in the short term because we're not aware of any issues that are coming through the process. I think I wanted to finish just with slide 28, and this just gives you a high-level overview of the IFRS 17 implementation support that is out there, that is available at the moment. Clearly, there's a lot more information available on all the topics I've spoken about. There's a lot of individual webcasts that drill down into each of the topics. And we would encourage anybody that wants to follow up on IFRS 17, wants a little bit more information, to go into that detail and to see a little bit more from there. The TRG will continue to receive submissions, so if you have questions, there's nothing to stop you sending in those submissions. The staff will evaluate the submissions and on the basis of that decide whether we should issue additional educational material or whether there is something that would give rise to us needing to constitute another TRG meeting. And I think with that I'm going to finish and hand over or hand back to the chair.
Thank you, Darrel. I will pass over to our IAN 100 experts, just drawing your attention to use the Q&A window in your WebEx application. So far, we have not received any question. You may pose questions throughout the webinar, and the Q&A session will be toward the end of this webinar. So, Dave, the floor is yours.
Thanks very much, Gábor. It's Derek Wright starting this, and Dave will chip in a few minutes' time. So IAA support for implementation of IFRS 17. We have got the International Actuarial Note, IAN 100, I'll talk about in a minute. There have been published over the last few years 3 education monographs, one on stochastic modelling, one on discount rates, and one on risk adjustment. And Dave will cover that later on in this presentation. And then we've got various seminars and webinars that we will potentially be hosting over the coming months. Today is the first. There may be other similar sessions to this. And we're also considering whether we should have a webinar on particular chapters of the IAN. It's something we've talked about, and it will be good to get feedback whether people think it would be helpful to go through particular chapters. So if I can move on, please. Thank you. So as Gábor said, an education or an IAN is an education note. It's not a standard. But it is there to provide actuaries with assistance when they're starting to look at something like IFRS 17. An international actuarial note is not binding. It will be up to local member associations as to whether or not they adopt the IAN as it is, whether they produce their own education material, making use of it, or ignoring it completely. It really is up to each member association, but it is a model education note for people to use. the IAN is not intended as interpretation of a standard such as IFRS 17. It's certainly not the IAA's responsibility to interpret any accounting standard. The IASB have other ways of doing that, and we certainly wouldn't want to be accused of interpreting anything. But we are trying in the IAN to give examples of techniques that could be used to address some of the matters that come up in the standard. In our documents, there are illustrative examples to help understand some of the topics, but they are just that, they're illustrative examples. And every case that anybody has got to be considered in its own right. You can't just say, the IAN says this, I will do that. You've got to consider yourself, what is the right thing to do. Can we move on, please? Thanks. So the IAN was exposed at the beginning of early in January. The exposure period is until the 26th of April, and we are looking for as much feedback and comment as possible. We want people to look at it critically. You know, have we missed things? Have we gone too far in some aspects? And we are looking, you know, do people think a few more examples would be helpful? And if so, you know, help us in the crafting of those examples. But what we don't want and not looking for is something about a specific topic or a specific product that is just in one country, because that should be in any documents that a local member association does. But if it's a product or an issue which people think may go over a number of countries, then that would be good to have as an example. The IAN has been under development for a couple of years now, and it's sometimes it's been a bit like shooting fish in a barrel, because you know, as the IFRS 17 has developed, you know, there have been a few changes. We decided we would lock this IAN down back in the summer, based on the standard issue in May 2017, but also reflecting discussions held at the early TRG meetings. And so it doesn't reflect the various things that Darrel has been talking about this morning. It doesn't reflect some of the topics that came up in the September TRG. The only change that has been made to the draft to reflect recent discussions was in Chapter 12 on transition, we did change the implementation date from 21 to 22, just to help people in looking at, well, what do I need to do by when? But of course, that was all subject to it being approved by the IASB when the exposure draft goes out. So why did we issue it when we did? Well, a number of member associations had been asking for us to publish a document because they were beginning to develop material in their own jurisdiction, and so they wanted to piggyback as much as they could on what the IAA had been doing. But we do know that when we get the comments in, and when we sit back and reflect on the various changes that are being proposed, we will need to update the IAN. So what does the IAN look like? Well, it's 15 substantive chapters based around question and answer. The aim is that each of those chapters is freestanding. So if you want to look at the risk adjustment chapter, you can read just that chapter without having to go through any of the other chapters. Although, of course, we would encourage everybody to read all 270 odd pages of it. A number of us have had to, so it would be good if everybody did. But seriously, when you are if you want to understand a particular subject or you considering a particular subject, you can go just to that chapter, and hopefully that will help you. So section A of the document is around what we're referring to as the general measurement approach. So the first chapter, classification of contracts, does look at, well, what is required by IFRS 17 for classification. But then the next 5 chapters, estimate of cash flows, discount rates, risk adjustments for non-financial risk, unit of account, and CSM, are for the general model, for the building block approach. There are adjustments, or different approaches that can be used for premium allocation approach, PAA, and for the variable fee approach. And so the IEN does consider those separately. So Dave, do you want to move on? Dave?
Sorry, I was muted. I think I'm okay now.
Yeah.
Yeah, if everybody can hear me. Yes, just moving on. As Derek said, Section A dealt with the what we regard as the sort of standard measurement approach or general measurement approach. In Section B, we've got 3 chapters that deal with significant variation to that approach. In particular, in Section 7, there's the premium allocation approach, which is basically an approach, a simplified approach that can be used in certain circumstances for portfolios where the full general measurement approach is deemed not to be necessary. So that's mainly, of course, relating to the non-life 1-year contracts or contracts of 1 year or less. But it also may relate to contracts that where the general measurement approach is effectively being mirrored, if you like, in the approach that's being used. So in other words, there's a set of criteria that can be met, if you like, where the premium allocation approach may be used to substitute for the full general measurement approach. But what we wanted to do was try and create a discipline so that the set of questions that actuaries are asking themselves in deciding whether to recommend the premium allocation approach to at least create a discipline so that the questions are going to be the same sort of questions in different companies. So we get some sort of semblance of regularity, if you like, to the use of the premium allocation approach. But again, as Derek said earlier, this is not guidance. This is, if you like, focused education. So what we've tried to do is ask the sort of questions that will allow actuaries to make their own decisions. Moving on to Chapter 8, we deal with the second sort of major variation to the general measurement approach, which deals with contracts with participating features and other variable cash flows. So here, if you like, we're dealing with an extra layer to the general measurement approach to allow for these types of contracts. So what we do is look at the definition of a direct participating contract, the definition of investment contracts with discretionary participating features, and also we open the subject to other types of contract that may fit the requirements for what's been described as the variable fee approach. So again, it's a means of if you like, establishing what the IFRS 17 requirements are, what areas of actuarial interest would be in those areas, and then the third level, if you like, looking at the type of means that actuaries may use to deal with those. So as Derek said, in some cases we've got illustrations, in other cases we've got more detailed questions. We're basically sort of setting the stage for an individual actuary to basically go through the process and work it out for him or herself. And the final part of section B is on reinsurance, and I guess when you look at IFRS 17, at the high level, basically reinsurance contracts mirror the direct contracts approach, but of course, as we all know, in reinsurance there are differences in the way that contracts are applied, there are differences in the type of contracts, and there are some differences in IFRS 17 as well, particularly in relating to the use of onerous contracts and so forth. So what we try to do for both reinsurance held and reinsurance assumed, we deal with those sort of questions in Chapter 9. So moving on to Section C, we talk about fair value, which Darrel spent some time describing earlier, so I won't spend much time on this, but basically we're seeing this as a particular area of actuarial focus, and again the focus is to attempt to increase the consistency in the approach to the use of fair value across the world. And obviously there's a linkage with IFRS 17 and existing common industry practices, but there are also two specific chapters here on areas that will need the use of fair value. So the use of the application to business combinations and portfolio transfers in particular, and then of course the transition process, which as Darrel mentioned earlier, if fair value is effectively the backstop for when the retrospective or the modified retrospective approach can't be used. And again, we're trying to introduce the type of questioning and the type of structure, if you like, to enable the use of fair value to be used in a way that increases the transparency of the way that the accounts are being produced. So if I can move on to the next page, please. So the final 3 of the 15 chapters that Derek mentioned earlier are dealing with topics that we really couldn't fit into any other section, basically, but also obviously important topics. The first one is the embedded derivatives, the requirements for separation of certain derivatives within contracts, and we try and deal with those as specifically as possible in that chapter. Then there's a chapter on contract modification and derecognition. So in other words, what we're doing here is saying in what circumstances would a contract modification be recognized as a significant change to the original contract and therefore need for a modified contract to be set up. So again, going through that discipline, that set of questions to ask whether that process needs to be done. And then finally, we've got what some may say is probably the most important area of the note, which at the moment is sort of tacked on as Chapter 15, which deals with measurement, presentation, and disclosure. And as I say, arguably, the way that presentation and disclosure develops from an actuarial perspective is going to actually set out the way that the standard is going to be applied going forward. So I think, certainly from a personal point of view, I see this chapter as the one that will perhaps be amended the most as we go through the process of exposure and readjustment and discussion internally and so forth. Okay, so that pretty well describes where we stand on the IAN 100 draft. As Derek was saying earlier, we've been working on this for a couple of years, and in fact, the subject matter for the draft, we've been working on it pretty well as long as the IASB have. We've had people, working parties, groups within the Education and Practice Subcommittee looking at these issues certainly since 2005 and probably in some cases a little bit earlier than that. But now we're looking forward. So we're saying we've got this IAN out for exposure, as Derek said earlier. We want those comments back. Hopefully the right sort of comments that he described earlier by the 26th of April. We'll be holding a meeting of the Education and Practice Subcommittee in mid-May, where we'll have some early discussion of those comments, but that discussion will continue during the rest of the year. And then depending on the type of comments and depending on the way that we can deal with those, we'll be either releasing a further exposure draft or we'll be moving towards hopefully what we're describing here as a final draft of the IAN by the end of 2019. But of course, final is probably a bit of a poor description, because this IAN, by its mere purpose, is going to be a moving feast, if you like. It's going to be a dynamic document, so we'll be looking to make changes as the movement towards implementation of IFRS 17 gets closer, and increase the number of case studies, for instance, particularly as companies become more and more practically inclined, and we get the sort of feedback that looks at specific instances, and we're able to incorporate those into the note. As it says there, the access to the progress that we're looking for is going to be available online on the IAA website. So again, we'll be looking for people to stay as active as possible in their feedback on the IAN itself. So if I can move on again, yes, thanks. As Derek mentioned earlier, what we've found as we've gone through the process of producing this IAN is that when we've looked at the background actuarial education, there's lots there, obviously, and there's lots that's already in use, but sometimes we're finding that it's very hard to see the wood for the trees, if you like. So we've decided initially the subject matter we used was stochastic modelling. We felt that although the material was there in the ether, if you like, we needed to try and help the educational focus by asking for a note to be produced. And the way we did that was we put it out to tender, and we asked for actuarial firms with a global reach, if you like, to get back to us on that. And the successful tenderer for the first note was actually Micheline, who did, I thought, an excellent job of pulling together an educational monograph on stochastic modelling. Given the success of that, we decided that it was worth going forward and continuing different subjects. And second subject was discount rates. You'll spot the theme here. We're looking at things that are actually useful for the IFRS 17. But this discount rate note was written as a more general guide. But again, it was a guide where we were looking for focus on the areas that were being used globally in a practical fashion. And again, Micheline won the tender on this one, and again produced an excellent note on the discount rates, which I think was released at 2014 from memory. Following that discount rate note, we then moved on to the next area where we felt needed some educational support. This time, when we looked at risk adjustments, we were actually really focused on the definition of risk adjustment in IFRS 17. So although actuaries talk about margins for risk and adjustment for risk in a whole range of contexts, this actual note is specifically designed for IFRS 17. In this instance, we broke the Micheline monopoly, if you like, and Deloitte won the tender, and again over a period of years, and it was a bit frustrating because as Derek was saying earlier, we were sort of in this particular instance waiting for things to be finally decided under IFRS 17 before we produced the note, so that we wouldn't create any confusion. So this risk adjustments monograph was not produced until last year in its final form, but again, we think we've got something that's really quite important for actuaries worldwide to use as a educational support and as reference work, if you like, and a means of increasing the efficiency of the way that they look at the issues that are relevant for the IFRS 17 support. Okay, next slide, please. Again, as Derek mentioned earlier, our support in a way is really only just starting. Although we've been working hard and long on things like IN 100 and on the educational support monographs, we now feel that our job will perhaps be a little more practical. We'll be looking at webinars, we'll be looking at partnering with other organizations. We'll be looking, as I said earlier, at the production of more case studies that will assist actuaries in going forward. But I think we've also got to remember that we're working with our member associations as well, and a lot of those member associations will be producing their own material. So we need to think about the boundary between, if you like, global material and specific association material in producing that. Okay, so I think, unless there's something else, Derek, that you wish to comment on, I think we can probably leave that there and move back to Gábor for his next introduction.
Thank you, Derek and Dave. So the next part of the presentation will be coming from Micheline Dionne, who is chair of the ISAP 4 task force, and she will be talking about the second exposure drafts of ISAP 4. So Micheline, the floor is yours.
I would like first to thank you, Darrel, for all your presentation and for all the efforts made by the IASB to get to the best possible accounting standard on insurance contract, because it's not an easy task. I'd like to thank Derek and Dave for presenting the efforts of so many volunteers that have given life to IAN 100. For my case, I will present the ISAP 4 second exposure draft, which is a model standard on actual practice for insurance contracts, as Gábor explained. First, let's review the activity to date. Since the publication of IFRS 17 in May 2017, we have been able to publish a first exposure draft of ISAP 4 less than 1 year later, that is on February 2018. You have been numerous in providing comments that have been very much appreciated and have contributed to many improvements. We are now providing a second exposure draft, which comments due on April 30th, that is at the end of this month. We have not made fundamental changes, but nevertheless have made several editorial changes, enough to warrant this second exposure. So what we've done, we have improved clarity. That is, we use simpler words where possible to facilitate understanding by non-native English speakers. We have taken out synonyms to stay closer to the IFRS 17 language and to ISAP 1. But mostly the changes are related to IFRS 17 consistency. You have noted to us some repeat of IFRS 17, and we took out those that were indeed repeats. Not all noted were repeats, though, as some were more complementary in nature. You suggested to us to add guidance where you felt some was missing, and we agreed to add where we felt it was a useful addition. The rationale for all the changes made and the review of comments is detailed in the documents accompanying the second exposure. Please read them before submitting comments to the second exposure. This is not yet the fatal flaw step, but we're hoping that we're moving in that direction. Next slide. So what are the remaining steps? Starting in May, especially in the Washington meeting, we will review the comments that you have sent to us, and we'll make further changes in reaction to them. And then after that, we are going to expose it as a fatal flaw. If everything goes well, the IAA Council could vote on the approval of ISAP 4 in its Tokyo meeting in November 2019. Otherwise, I guess we'll have to wait for the May 2020 in Brussels to finalize the document. I know that it's not going to include any of the changes that Darrel talked about because we're basically already engaged enough in that process, and the idea was to finish it at as early date enough for it to be useful. But once the process for the ISB will be over, we're going to look at it again to see if it requires changes. It's not because a change is made in the IFRS 17 that we will need a change in ISAP 4. It depends whether it implies principles that add guidance for actuaries or not. So that's next slide. Next slide. I'm very thankful to all the members of the task force who worked very hard. So I'd like to thank you and have you to recognize them. You may have some that you know from your region, and so they are accessible if you want to talk to them or have some insights. And I guess this is all my presentation. You're welcome to come to the ISAP 4 session in Washington for those that will intended to attend that meeting.
Thank you, Micheline.
Yeah.
Yeah, thank you. And then now it's time for questions. So as we agreed, first we go to the live audience in London. So if there are any questions from the floor in the London office of Milliman, then please go ahead. And then we'll see questions submitted online. Darrel, there is no question from the floor in London office?
Yes. Sorry, there was a question, Gábor. The question was, when the new exposure comes out from the IASB, would it be focused just on the changes? And Darrel was just about to answer.
So the typical process that we follow with an exposure draft is to specifically focus only on the changes we are proposing, and we would have a list of questions, probably a question on each of the individual changes that we've identified, asking whether people agree with that particular change. If not, why not? We would not answers coming in that go beyond that particular mandate. But clearly from the board perspective, what we're seeing is the need to move along with the processes as quickly as we can and as efficiently as we can. So it would need to be something fairly fundamental to cause us to look at that particular issue.
Thank you. Darrel, for the exposure draft, obviously all the proposed changes will then subject to consultation. What happens during the course of discussion? The ISB decides not to commit to certain proposed changes. How likely? In the past, we have experience like that.
So I think the question there was just how likely is it that we might change our mind, I guess, as a basis of the feedback, on the basis of the feedback that we receive. So clearly this is a consultative process, and that means that as much as I think the board believes that we've gone through a proper due process, we believe we've spoken to constituents across the board, and we believe we've got the right outcome here. It is possible that there may be information that's fed back to us through the consultative process that would lead us to change our mind. We are open to changing our mind if we need to, and if we did that, that would not require, for example, another exposure. What we typically do in an IFRS exposure draft like this is that we explore both the option we considered, and if we considered another option, we explore that in the in the exposure draft. That gives the opportunity to people who are responding to us to comment both on what we've said we will do, and if we've said we will take a particular approach, we give an approach on reinsurance, we will follow a particular approach on reinsurance. We rejected the following two other approaches. People have the opportunity to respond to that. So I don't see the need for a re-exposure in the circumstance because we are providing the information to it, and because to the answer to the first question, this is a limited scope question that we're asking.
Are there any other questions here in London? No. Gábor, back to you.
Thank you. It seems there is one or some questions in the Cape Town audience coming from? No? Well, if none, or until they make up their mind, I would ask a question, Darrel. So one can hear some kind of criticism that one of the objectives pursued by the development of IFRS 17 to achieve a targeted higher level of consistency of insurance reporting may not be realized, at least not on the short run. Does the IASB plan to monitor the actual application and implementation of IFRS 17 for achieving the objective of a higher level of consistency? And if so, can the IA assist the IASB in this process?
So let me answer that in two parts. I think the first answer to it would be that the educational webinars and the TRG process were deliberately designed to give a public forum in which issues where there is potentially emerging inconsistencies can be discussed. And so that gives us the ability from the ISB perspective and from the participants in the TRG process to give air to these areas where there might be diversity emerging and have the discussion around those issues. Equally, the amendments that we're proposing at this point in time, some of those amendments are specifically clarifications, and we would anticipate that those clarifications of the standard is likely to reduce diversity in practice. We will continue, as I mentioned when I spoke earlier, we don't have plans for any further TRG meetings, but we're not disbanding the TRG at this stage. So we will continue to monitor whether or not there is emerging inconsistencies through the process or emerging diversity in practice. In the longer run, the ISB has the Interpretations Committee, and the Interpretations Committee is also directly mandated to look at and understand where diversity is emerging in practice and to address that diversity if it can. But clearly, we would also look to cooperating with other organizations across the world, the IAA being one of them, with a view to seeing whether or not there is something in terms of educational guidance and other things that can be produced that might help with that. We might want to just ask if somebody's got their mic on. There's quite a lot of noise coming through again on the line. There you go. That did it. There was one other point I wanted to add, which is I think the ISB has historically had experience when we've introduced new standards that we do expect that firstly in the lead up to the application of the standard, there's a fair amount of, whenever judgment is required, whenever you're dealing with principles based, there's a fair amount of initially people coming from a wide diversity of views and slowly coalescing towards something that is more concentrated. And we see that both up to implementation of a standard and sometimes immediately post-implementation. When you start seeing how your competitors have dealt with a particular issue, you tend to find that the convergence continues afterwards. In the context of IFRS 17, we actually expect that to continue a little bit longer, and that's because of the fact that most of our standards are written from a common platform. IFRS 9 was written from IS 39, so people were already doing something consistently. As I mentioned earlier, they then embarked on a journey down the same road. IFRS 16 was written off the back of IS 17. So in most of these circumstances, what you're seeing is people moving from a common starting place to a common end goal, and so there's less diversity because of that journey. In IFRS 17, we expect that this convergence of opinion will take a little bit longer because of the diverse starting points and consequently the diverse systems and things that have been implemented, the diverse product development that exists across the world, and etc. And certainly from our point, the primary thing that the ISB will do to assist in this is to highlight where these inconsistencies occur and to look to organizations like the IAA and see whether or not there is a chance to develop further guidance to help people in that process.
Thank you. Gábor, did you have other questions either in Cape Town or from participants throughout the world?
Yeah, there are some questions. Yeah, just a moment. So one question is how does IFRS 17 incorporate that and allow the development of predictive analysis and big data if we are to look into the future with accuracy?
I think you've just made a very good case for principle-based standards. So essentially what IFRS 17 tries to do is to specifically focus on the outcome. So your reporting objectives, your reporting principles, what you should be trying to achieve. What it does not do is to a great extent define how you go about achieving that outcome. And changes in product, changes in data availability, changes in data analysis, changes in market environment and the way markets think are not built into the standard. That is the back end of the standard. And so we would expect, and in fact we've been in a number of conferences over the last couple of years, where there has been specific conversations about how moving into a new world of big data and other things may end up changing this. And a clear example of this is that when we talk about data, the data that you should be using to achieve the outcome, we will talk about in the standard data that is available to get without undue cost and effort. We're not requiring you to set yourself up to have the best data in your particular market or to have a quality or standard of data that is above what you currently have. You use the data you have to get the outcomes that we target. And as that data availability improves, so we would expect your reporting to improve with it. But the undue cost and effort is one of those clauses, one of those phrases that allows us to accommodate the improvements in data over
time. Thank you. There is another question requesting explanation of the distinct and non-distinct investment components, but I would ask the person who asked the question to look into the IAN 100, and I think explanation will be found in there. There is another question requesting a confirmation that reinsurance EIF monetization transactions are indeed dead within IFRS 17, and how former VIF monetizations will be treated from a retrospective basis.
I'm not sure I followed the question.
No, we struggled to pick up the question here, Gábor. Are you able to repeat it, please?
Yes. Can you hear me now clearly?
We can hear you, but you're breaking up a lot.
Okay. The question is...
Maybe a second time.
Please confirm if the reinsurance VIF monetizations transactions are dead with IFRS 17, and how former VIF monetizations will be treated from a retrospective basis.
So maybe if I can pick up what I think are the two important components there.
Okay. Another question.
Okay. I think that, so let me perhaps deal with this at a high level, and we can dive into the detail if we need to. So I think the first element is to say that because the IFRS 17 approach for both reinsurance and insurance contracts is the same, it works on the same principle, which is the present value of future cash flows, risk adjusted, with the profit spread over time. Arguably, what you're dealing with is whatever the expected cash flows are within a contract, irrespective of how the contract itself has been verbalized, how the contract itself has been written. We then have a little bit of an exception for reinsurance, because what we've said under primary insurance contracts is you spread the profit over the life of the contract. Under reinsurance contracts, we say that you spread either the profit or the expense, because from time to time, a reinsurance contract, you're going to be paying up to get the risk cover. So you spread either the profit or the expense over the life of the cover that you are receiving, with an exception that if the underlying contracts reflect a loss, and that underlying loss is compensated for by cash flows that you expect to receive under the reinsurance contract, you will then release some of that expected profit on reinsurance into the profit and loss at the same time. So the objective with reinsurance is to try to achieve, to the extent that reinsurance economically achieves protection, to reflect that protection in the income statement. Transition for reinsurance works exactly the same as transition for primary insurance. So you have the same three options that were mentioned earlier: fully retrospective if you have the information to go back, modified retrospective if you have some but not all the information, or purely prospective if you only have forward-looking information. I thought I'd just touch on your other issue on the question of indistinct and distinct and non-distinct investment components. For whoever asked the question, if you're interested, that is a question that will be specifically discussed at the TRG tomorrow.
Thank you. We have another question here. To what extent will IFRS 17 be a useful metric in day-to-day business decision making?
And it's a fascinating question, because we have had quite a lot of feedback in different elements of organizations. And I think a very early response we got to IFRS 17 being published from the preparer community was they didn't think this element and this element was going to be useful for them. And I think our initial argument that we made from an ISB perspective was that sadly the objective of IFRS 17 was never for management, because management has the access to all the information they ever want. The objective of IFRS 17 was for investors, because investors are the people who don't have access to pick and choose what information they want, and to develop systems to get the information. So our starting point would have been to say that wasn't necessarily a consideration in the development of IFRS 17. What we have subsequently heard is a number of insurance companies, as they have progressed to the development of their underlying systems, are deliberately focusing their systems development in order to produce management relevant, management useful information. And one simple example of that is that under the existing IFRS 4, you were allowed to have different accounting systems in different entities. So I mentioned when I was doing the tee-up that, for example, one entity, let's say a Canadian-based entity, would have been using CALM interest rates, so they would have been using interest rates that were updated to reflect the asset requirements. A South African insurance company may have been using his current interest rates, market-related interest rates relating to the liability, and I think a specific Asian country, so I'll say a particular Asian country that I can think of, has been using historical interest rates. And what was happening in the head offices of a number of these insurance companies is that they hadn't gone through the exercise to develop a consistent methodology of looking at their business. So when they looked at their subsidiaries in each of those jurisdictions, they were getting very different types of key management information from each of them. In the development of the solutions to IFRS 17, they've also developed internal key performance indicators that now measure those underlying businesses on a consistent basis. We've also heard of other things. The cohort process, which requires an entity to split its business into underwriting years, has led to some entities looking at whether or not there is a way that they can better manage cohorts as they go forward. Some of that is the effect of simply having the information or needing to get the information available for 17, so now that information will be available from an internal perspective. Some of it is because they want to be able to answer the questions from analysts and anticipate questions from analysts as they go forward. And some of it seems to have been a genuine epiphany that actually there's something in here that will be very useful for us to understand the underlying business. So I think the answer to your question is I don't think it's consistent. I think there are a number of different insurers who are developing different spaces. It is an evolving discussion, and we're hearing more and more usefulness From an ISB perspective, this wasn't our objective, but we're very pleased to see the developments that are happening.
Thank you. There is another question here. With respect to the proposed amendment reinsurance contract, would it allow reinsurers to offset proportionate share of loss on underlying direct contracts to recognize under this contract? Would any other type of reinsurance be eligible, like stop loss, or only proportional reinsurance?
So under the existing guidance, any reinsurance where there is any reinsurance that over the life provides protection for an underlying insurance contract is you get the mirroring benefit, you get the reinsurance benefit. Under the proposal, but under the existing accounting, you do not get relief on a day one loss scenario. So a scenario in which you've made a loss on the underlying contract on day one. The proposed relief would provide that day one relief for proportionate contracts as well, but would not provide it in the circumstance of a stop loss. And the rationale for the board developing that proposal is to say that in proportional, when I write a brand new contract today, in a proportional space, I can identify on that brand new contract exactly the extent to which the reinsurer is going to absorb the loss of that new contract I've written. On non-proportional business, the reinsurer is essentially dealing with, and take a stop loss situation, the reinsurer is essentially dealing with my back book as well as with the contract that I have just written. And in that circumstance, it is arbitrary to try to allocate what part of the stop loss relates to the contract I've just written, and what part of the stop loss relates to contracts I've previously written, and what part of the stop loss relates to contracts I have yet to write. And so the board said we would only provide that in the case of proportional. Just to let you know, we have one more question. We have a question in the room again here in London.
Okay, if I may. You mentioned that the standard is primarily for investors. The objective was for investors. Who are the investors who are providing feedback on IFRS 17? What's your sort of conduit to get investor feedback?
So the question there is just how do we engage with users? Which users are we speaking to? How exactly do we get input from investors in the investment community? So a number of different mechanisms here, and I'm being a little bit shorthand in saying investors. What I should actually be saying is users. It's anybody who uses financial statements. Some of those users are regulators, and they're very easy to engage with, and we tend to find that through the general regulatory organizations, we get a number of specific feedback through the process. For the user community, there are a number of specific user organizations that we engage directly with. The CFA Institute is one clear group of users or investors that we engage with. In addition to that, since the publication of the standard, we've met something like 500 investors over the investment engagement process we've got. That's meeting with both the credit agencies, some investor organizations, both sell-side and buy-side investors, and also general investors and insurance-specific investors. What we've done with that is we've sort of linked it into a joint, call it education process plus engagement process. So we bring them up to speed on what IFRS 17 is. We identify the specific IFRS 17 challenges that we've been hearing, and then we ask people for their views. And in the 25 targeted topics that we heard about, some of those topics were actually raised with us by investors for consideration.
Thank you, Darrel. I think we ran out of questions and time as well. So what remains is I would like to recognize our speakers and thank Darrel, Derek, Dave, and Micheline for providing this information to our live audience. Thank you very much. The IAA will assess whether or not, to what extent, there is a need for further webinars, maybe on more specific issues. We understand that this was quite a broad subject, a high level, so we will make an assessment to what extent we would continue and in what direction. So thank you very much, everybody who joined this live webinar. As it was mentioned before, the slides and the recording will be available on the IA website. Thank you very much, everybody. Bye.
Thanks, Will.
Thank you.
Thanks, Darrel.
Bye.